Hey friends, so Warren Buffett, he once said to be fearful when others are greedy and to be greedy when others are fearful. I want to go through in the video today 2 times when I was really greedy when others are fearful, and this paid off for me in a very big way. I also want to go through in the video today several positions that I think others are really fearful about right now. Therefore, I want to be a little greedy. I want to be a contrarian. I want to go against the sentiment, if you will, because I think there's some opportunity there. And I think the news, the media, the prevailing thoughts, the trends right now, they're creating a lot of fear in these particular positions, but I believe that there is long-term upside. And so first, what I want to do is I want to rewind. I want to go back to 2019. Check it out on the screen right now. How many of you remember this screenshot, remember this video? This was me back when I was on a business trip in 2019. I was in a hotel room. I was trying to speak kind of softly so as to not wake up the other guests because I was up late at night filming this video, and it says, "Alert, I'm buying this dividend value stock immediately." This was a really popular video. It got over 20,000 views back in 2019. And at the time, what I was talking about was AbbVie. AbbVie is a large healthcare company, pharmaceutical company. And what was happening back in 2019 is all of a sudden, the news, the media, the sentiment out there was really negative about this stock because their flagship drug, Humira, was coming off of patent protection here in the United States. And analysts were scared and fearful that this company would implode. And you can see on the screen right now, this is really awesome. I want to share a Google Trends. You can see Google Trends here for AbbVie, just typing in the word AbbVie. How many people are even searching for AbbVie day to day other than investors in the investing community? Probably not too many. I think anyone searching for AbbVie on the internet is probably looking more for the names of their particular products like Humira. But you can see back there, in 2019, in particular, right around when I did my video on it in June, there was a huge spike in interest, a tremendous spike in interest. And what this interest was, is it was negative sentiment about the company. Everyone was worried because the analysts, the reporters, the media was having a field day with this one that, oh my goodness, with Humira coming off of patent protection, it is over. Now, I want to share some thoughts on the screen, some metrics, if you will. Check it out in front of you right now. When everyone was so negative on this thing, I went ahead and bought. And you can see here on July 29th of 2019, I bought at $67.76. And currently it's trading at $145.11. Now, even though it's 13.7% off its 52-week high, I'm still up on that first tranche, 114.2%. And so that's some nice capital appreciation there. But I don't invest for capital appreciation. That's the icing on the cake. I want to get into the dividends because I'm a cash flow investor. You can see the earnings estimates here. Even on the current $145, this doesn't seem like a bad value here. It's trading at a PE of 13, but because I bought it 67.76, my PE ratio on cost is a 6. You can see that on the right-hand column. All I do is I take the price that I paid, $67.76, I divide it by the earnings estimates this year, which are $10.94, and I get a 6.19. But here's where it gets interesting. The current dividend per quarter is $1.48 or $5.92 per year. The starting yield, dividend yield, is 4.08%. Not bad. That's actually a pretty great starting yield. I like it for a qualified dividend, but it gets even better for me. My simple yield on cost on that first tranche is an 8.7%. That does not even count reinvested dividends. All I do is I take the current dividends per year, $5.92, and I divide into my purchase price of $67.76. I get 8.7. And with my reinvested dividends, my true yield on cost is even higher. Now, you can see they're growing the dividend per year on average by 9% as well. This is a $256 billion company. And taking Warren Buffett's philosophy to heart of being greedy when others are fearful, they really paid off for me here with AbbVie. Now, I am not creating this video to brag or to say that I am always right. That is far from the case. In fact, I am sharing my investing journey here on YouTube for fun and entertainment purposes only, and I share all of it here, my successes, my mistakes, my pitfalls, my learning lessons, all of it. But what I'm trying to say in the video today is I'm taking a look back in time at what I have done right so that I can make even better decisions going forward. And one of the things I realized recently is I have been really right when I have been greedy when others are fearful, and I have gone against negative sentiment, particularly with blue chip, high quality dividend stocks that I believe in over long periods of time. Because we know investments, they don't always just go up and to the right. They go up, they go down, they go up again, they go down again. It takes time. It's a rough journey. It's a hero's journey, if you will, for a dividend stock to make it to new heights. And I want to share that with another stock right now. As you can see on the screen right now, I just want to start actually with the Google trends on this one. This is a fun Google trend as well. You can see that for Starbucks, my number one dividend stock position, there were some real peaks in interest over time, in particular when I look at Google trends for Starbucks Union. This whole unionization concern that the media just had a field day with, it really spiked there two different times in kind of that 2021 to 2022 time frame. And you can see the first spike was tremendous. The second spike was pretty big, but a little smaller. And now interest has been tapering down over time. Well, it just so happens that to coincide with all of this negative sentiment around the unions, I had a very long-term belief in Starbucks, and I also just looked at the data. So I'll go back with AbbVie. The reason I went ahead and I bought AbbVie is it was a pure value play. I looked at the numbers at the time, and I felt like the media was just going overboard with Humira. They were going overboard because when I did some analysis and I looked at Humira and I looked at how much revenue, how much earnings they might lose from the thing, I felt that even in the worst case, the stock was really undervalued. And then with Starbucks, I started doing the same thing. I looked at the data and I said, hey, you know what? Let's look how many stores have unionized. And when I looked at their 30,000 plus stores, only like 200 at the time have unionized, and now it's only about 300. I started putting together the data and I saw a mismatch between the sentiment and between reality. And I think that's what's most important with Warren Buffett's quote, is not just blindly being greedy when others are fearful, because sometimes people might be fearful for the right reasons. But with Humira and also with Starbucks, I think the fear was overblown and it was amplified by the media, because when I looked at the facts, only like 200 stores had unionized out of 30,000 plus stores. And so anyway, as you can see on the screen in front of you right now, here's a video that I did. You can see this one was from June 2nd of 2022. And I really described in this video how Starbucks was destined to become my number one position. Now, by the way, I'll link to both of these old school videos in the pinned comment below so you can check them out. But at the time, back in June of 2022, J&J was still my number one position. But I was discussing how Starbucks, and then it was trading at $76.65. We'll get into the current metrics now, but it's way up since then. I was buying Starbucks, I was adding to a lot of Starbucks, and I was putting faith that this negative sentiment out there, it was so overblown versus the reality, because I know what I own, I know the metrics, I understand what I'm buying, and I realized that the media was going overboard when Starbucks was just tapering off, and it was hitting the front pages of the media that these unions were going to take over the company. Well, with that background, I want to share, where is Starbucks at right now? Check it out on the screen in front of you right now. These are the current metrics for Starbucks. And you can recall on the prior screenshot back on June of 2022, it was trading at $76. Well, now it's at $105.51. It's still 8.6% off its 52-week high. Still has room to grow from there. But you can see that the capital appreciation there in just about about 1 year's time, not even 1 year's time, is 37.7%, just by being greedy when others were, I would say, irrationally fearful. And I think that's where I really, again, need to clarify Warren Buffett's quote that you, as an investor, in my experience, it's not just about being greedy when others are fearful, because maybe people are fearful for good reason, but it's when the fear is irrationally overblown given the data that exists. And as you can see on the screen in front of you right now with Starbucks, I don't want to spend too much time, but you can see that the current PE is about a 30 on a forward basis, 25 next year. But my PE on cost from those tranches in the $70 range is in the 20s, and it's forecasted to get even lower into the 18s next year. You can see that the current starting dividend yield is 2%, but my simple yield on cost is 2.8 because I bought at a lower price, and the dividend is growing about 12% per year on average. And based on what I see out in the marketplace right now, there is so much positivity for this company going forward. I think some of those union concerns linger, but I think over periods of time, this company would continue and will continue to flourish. That's my humble opinion. But again, I'm not sharing these two examples just to brag, because I have plenty of examples like 3M, for example, where I didn't really buy when the sentiment was negative. I bought it way before the sentiment was negative, and I have faced downside on that stock. So not all of my stocks have been winners. That is far from the truth. I'm documenting my journey here on YouTube. I wanted to start with these, though, to analyze how I can continue to evolve as an investor and be better as an investor. And what I'm starting to learn as a dividend stock investor is it's really important to have a basket of stocks, a portfolio of stocks, a line in the sand, but then to stockpile cash and wait for an opportune buying opportunity, a really good opportunity to buy when the sentiment is irrationally negative. And with that, I want to actually share a conference I just went to. I went to the MAULDIN Strategic Investment Conference over the last few weeks. I watched the conference at my own leisure. There were a lot of good presentations, and one of them was from Jared Dillian. And he really talked about sentiment, and that was the genesis for this video today as a dividend investor, because he framed some of the concepts I was already doing in a really good framework. And he reminded me how I need to really tap into my sentiment analysis as a long-term buy and hold forever cash flow investor, because I know that when stock prices are down, there's an inverse relationship with dividend yield. I get a better starting dividend yield when stock prices are down, irrationally speaking. And so I want to share some thoughts on the screen today, what I learned from Jared Dillian, but then I want to go in at the end of the video just to a few companies where I believe there's irrational negative sentiment right now. And so let's go ahead. Check it out on the screen right now. And so first and foremost, I want to give a shout out to Jared Dillian. If you want to follow him, he's the Daily Dirt Nap on Twitter, and he has a wealth of information on his Twitter. He's written a lot of books. He was a Wall Street trader at Lehman Brothers and learned a lot over the years about sentiment investing. But basically what he said at the conference is that millions of investors, they're fooled every day in the financial markets. They make bad decisions, the worst decisions. They panic at the bottom, they pile in at the top, and it happens year after year. Nobody ever learns. And so that is so sad, but true. And what he said is the answer is profiting from the irrationality of others. You want to do the opposite of what your instincts tell you to do. He says to take in all the sensory inputs, like talking to people, watching TV, listening to the radio, looking at social media, movies, reality shows. It all goes into the mix. He likes newspaper headlines in particular, like the front page of The Economist, for example, or Time. He looks at Google Trends, like I shared with you in the video today. And the goal is to be really bullish when the lows come in and really bearish at the highs. Of course, I would add to this list that it's important to know what you're looking at, because just because something is negative or there's a lot of negativity out there, it doesn't mean that it always pays off to be a contrarian. I would say it pays to be a contrarian when you really know what you're buying and you're buying quality when there's an irrationality out there. But he looks for enthusiasm, hubris, people making money out of proportion with their abilities and their knowledge, people who can't see how things would go wrong, people who have overconfidence, and these situations where people are making fun of those on the other side of the trade. Then they're there either really happy or really sad. In fact, on that point, I will tell you, when I was buying Starbucks heavily last year, I got so many comments that with this trying economic time that we're facing now with a lot of inflation, no one will buy the $5 coffee anymore. But so far, at least, maybe the naysayers, they'll be right in the long run, but right now at least, it has not come to fruition. Everyone is still buying their coffee and they are enjoying it, and they don't mind the higher price they're paying it because it's a simple pleasure, a simple escape from the daily rat race that so many people face. And so far, those naysayers, that negativity, they couldn't even see the other side of the trade. I had so many comments on my videos from back then, Ian, no way, you're wrong, this, that, and the other, but they couldn't even see the other side. And that's when I knew kind of inherently back then that, hey, the sentiment here, it's too negative. I better go long, go really long on this thing. And now it's my number one position by a large margin, even larger than Johnson & Johnson and Pepsi. But let's keep going. As you can see on the screen right now, what I want to share from Jared Dillian is he looks at newspapers in particular, because he said newspapers, they report on the here and now. It takes so much time for a newspaper reporter to actually research, to write the piece, to get it approved, to get it published. And by the time the newspaper piece comes out on the front page, it's kind of, that's the here and now, but it's not really the future. It's probably almost the tail end of that trend, if you will. And so when the news is really loud about a certain thing, Jared usually knows it won't be doing that in the future. No way. And in particular, the news thrives on drama. It thrives on being sensational, and just sharing the same story over and over and over, that's not going to sell newspapers. So you know they're only going to report on the hottest thing of the moment. And banks, for example, right now, regional banks, we know they're failing. We know there's a lot of drama in the banking sector overall. That's probably not going to be what people are talking about 6 months from now. And that's actually one of the trends I want to talk about at the end of the video today. He said the bear case is always most compelling at the lows, and you have to be willing to do the trade that doesn't seem to make sense at all. And so that's what I did with Starbucks. That's what I did with AbbVie as well, because with AbbVie, everyone thought that, boy, without Humira, this thing is toast. But what I knew is that Skyrizi was just around the corner. And what I knew was that Skyrizi sales were picking up like crazy. This was before the Allergan merger was even mentioned when I was buying AbbVie. But I had the faith that, one, the Humira decline in sales and revenue and earnings, it wasn't going to be a doomsday scenario. But what I also knew is that Skyrizi would probably pick up some of the slack there. And it did. Both of those things came to fruition. But what also came to fruition is I got a little lucky because that Allergan merger was announced, and it panned out much better than I think anyone could have ever expected. But with that, a quick summary of dividend stock investing. Check it out on the screen right now. The whole purpose of this video is to provide a framework, just another way to look at long-term cash flow investing, because I invest in dividend stocks. I like to buy and hold forever, and it's important that I make the best possible buys on any given time. And so we know there's an inverse relationship between stock price and starting yield. The lower the stock price, the better the starting yield. Closer one gets to dividend-based FIRE if that investor can buy at good prices. Step one, identify an amazing basket of buy and hold forever dividend stocks. I've already done that. I own 50 of them. I have a line in the sand on 50 different positions. Step two, wait for a great entry point, and sentiment can help. And we saw how sentiment paid out so well for me with Starbucks and AbbVie. And again, these are two stocks that worked well. I have numerous examples on my channel here of positions that I own and haven't done quite as well. I think probably one of the best examples of that I can think of is 3M, but that's funny because I want to actually talk about 3M a bit today. So you've been waiting, and what are some of the stocks right now that I think have good opportunity for capital appreciation and locking in value, because the sentiment is really poor right now. I'm going to share those on the screen, but also please put in the comments below if you have some of those. Let's brainstorm as a community and see if there's any contrarian stocks right now that that we all think are interesting. Share in the comments. But as you can see on the screen in front of you right now, what I want to share are 4 stocks. The first one is Altria. And so I've been buying Altria. My patrons already know know that I have a backyard Patreon, corner Patreon. I share the trades with all patrons. I'll link to that in my pinned comment below. But the starting yield is 8.3%. In preparation for this video, it's a Sunday. I didn't take as much time to put all the metrics in front of me for all of these stocks. But if I recall correctly, the PE ratio for Altria right now, I think it's like an 8 or 9 as well. It's really low. The thing I like about Altria is it's not really a news event driven company as much these days, other than it is that there's this prevailing terrible sentiment around it. And the prevailing terrible sentiment around it comes from the fact that so many investors, this is another theme that was spoken about at the MAULDIN conference, so many investors now are trying to invest in ESG. They're trying to invest in mutual funds and index funds, individual stocks that embody ESG, and that's a growing trend. Now, unfortunately, Altria, I don't think it really falls into anyone's ESG criteria, and it always seems to have a negative sentiment against it from that perspective. It also has some negative sentiment, just that the product that they sell, the core product, it has been in volume decline since, I would say, the 1970s, but they've been able to make up for that through increased pricing. And so there's some good things about it, though, too. They basically operate in a monopoly situation. I don't think there's going to be too many new market entrants into their category, given how difficult the category is. Their margins are really high. The dividend growth rate is high. The starting yield is high, and it's priced as if it's going out of business. The reason I've been buying Altria is because I'm interested in immediate cash flow right now. I've shared that in some of my videos over the past year, but also because it feels like a stock where I'm always getting that contrarian buy. I'm always getting that value. I don't know if I'm going to see a capital appreciation situation with Altria like I did with AbbVie or StarBucks. In fact, I would venture to say probably not, but I don't invest for capital appreciation. I invest for this, dividend checks. Check out the pinned comment below, by the way. I have a link to my merch. I invest for this, and because I invest for dividend checks, the capital appreciation side of it, it doesn't matter quite as much. What matters to me is getting the value and getting the yield and getting the dividend growth. And I feel like with Altria right now, I'm getting all of those because the sentiment has always been negative. But let's keep going. As you can see on the screen in front of you right now, I have a few more to share. And again, please share in the comments below which ones you think have negative sentiment right now. But I would say Johnson & Johnson with a starting yield of 3%. If I recall correctly, the PE ratio is somewhere in the 14s right now. I've been buying this one pretty much weekly. My patrons know that. The sentiment is very negative because of litigation risk. And I would say because of uncertainty with the Kenvue spinoff. But so far, Kenvue's gone really well. And J&J owns the majority of Kenvue still. They haven't passed on any shares to the shareholders yet. And so I own Kenvue through J&J. But with a starting yield of 3%, a PE in the 14s, a lot of growth ahead, a kind of demographic trend where healthcare is going to be in favor for our society. I've been going against the grain on this one. I have been out there venturing to say that this one is trading at too much of a discount as compared to the litigation risk. I've taken that approach. I could be right, I could be wrong, but that's a sentiment-driven investment that I've been making. And it may be that at some point J&J surpasses Starbucks in my portfolio again, because it's kind of like a spring that's being compressed. And at a certain point, that spring, I do think there's going to be that equity appreciation component to it there. It could be a year from now, 2 years from now, 5 years from now, but I think that will be coming when this litigation risk is resolved and passes. And so that's the second one that I think is a sentiment stock right now. The third one, as you can see on the screen right now, is actually in the banking sector. This is Bank of Montreal. It's trading at a dividend of 4.9% right now. And basically, this is a world-class large bank based in Canada, but for whatever reason, the stock price has been tumbling a little bit, and just because it's getting dragged down with all of these smaller regional banks that have been failing. But I think this is a perfect case that really ties into what Jared Dillian was saying, is that right now on the newspapers, the front page is regional banks and banking sector and collapse of the banks and the fact that interest rates have gone up and there's a lot of asset liability issues on the balance sheets of the banks. Well, I just feel like Bank of Montreal has gotten caught up in the drama of the smaller banks, and it's created a buying opportunity for me because I know this is a bank that is probably on the scale of too big to fail. I don't think the Canadian government, if they even did run into trouble, would want Bank of Montreal to fail, whereas the government can stomach a Silicon Valley bank or a First Republic bank failing. FDIC can come in, save the day, fix the situation there. But these bigger banks, they're probably not going to fail just because it would be too catastrophic for the economy. And that's why I've been buying Bank of Montreal. That's why I've been taking a contrarian play on that. But put in the comments below if you've been buying any bank stocks, if you see any contrarian banking opportunities out there. Now, with all of that, the last one, as you can see on the screen right now, that I want to share with all of you today is 3M. There is so much negative sentiment about this one. It is broken below $100. Everyone hates it. They're saying that's the next GE. Starting yield is 6.1%. You have a few things happening here. You have litigation risk with the earplugs, unfortunately. You have negative sentiment just because we're in a cycle right now where, industrially speaking, they're kind of out of favor. Their performance has not been so good. You just had some drama come out about one of their high-ranking officials at the company who was let go. Every single dividend investor and investor alike just seems to dislike this thing. There's talk that it might even be removed from the Dow Jones Industrial Average. It couldn't get worse. I am not necessarily going heavy on 3M right now. I may pick up some more here and there, but I'm reinvesting dividends. And I definitely think that this is one where it is a contrarian play for sure. But I listed it last for a reason. But let me know what you think. Put your thoughts in the comments below. Are there any stocks I did not capture that you think are contrarian ones right now where the sentiment, the negative sentiment, is blown out of proportion? I would love to know. If you enjoyed the video today, please go ahead and click the like button. It means the world to me. I'm filming here on Sunday. I'm doing what it takes to get these videos out, and so your support means the world. Also, please don't forget to subscribe. I have new videos on the way all the time. Before I go today, in terms of a full disclosure, I own the stocks mentioned today. I am long Altria, ticker MO, Johnson & Johnson, JNJ. I am long Bank of Montreal, BMO. I am long 3M, ticker MMM. I am also long StarBucks, SBUX. I am also long AbbVie, ticker ABBV. I own those stocks in my personal dividend stock portfolio. Also, by the way, I'm long PepsiCo, PEP. I think that was on a screenshot earlier in the video today. Boy, that one has done well. All right, everyone, before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. I'm sharing all of my successes, all of my learning lessons as well. And it's possible to lose money in the stock market. So again, this is just for entertainment purposes, not advice. I love you all. Thank you for watching the video today, and I'll see you in the next dividend stock investing video.